Hi, I'm Steven Van Metre, and welcome to your Wednesday night update where we spend 15 minutes trying to figure out what's going on in the economy and the stock market and how it relates to you and your money. So the big news today was on the Fed when they released their minutes from their December FOMC meeting. Now you're like, well, wait a minute. Why are they releasing minutes from December in February? Because that's what the Fed does. They usually wait a couple months, about December, January, February, 2 months afterwards, thereabouts. It varies slightly. And then they put the minutes out. And they do that because they need to change them before they release them. You're like, oh, conspiracy theory. No. Janet Yellen said the Fed meeting minutes are a policy tool that we use to change things when we need to. So, for example, they raised the federal funds rate in December. They thought that was fine. The market did not like it. So what do? You tweak your meeting minutes to make sure that the market's happy, because what the Fed's always trying to do is they're trying to, when they're hiking, so when they're easing, it doesn't matter, but when they're hiking, tightening monetary policy, their goal is to continue tightening and convince everyone it doesn't have any ill effects. And so they do that through public talks, through their FOMC meetings, through their meeting minutes, through press releases, through everything they can do. And so we know this is massage. Now, we don't know from what, because they don't say, here was the original one, and here's the one that, we're submitting to the press. No, we don't know that at all. But we do know they do use it as a policy tool to make tweaks. And what's the big deal since December? Well, is the Fed going to stop unwinding their balance sheet? The market is suddenly in an uproar. Well, we're going to go look. We're going to find out. Once again, it's not what everyone thought, because the news immediately hit. The Fed's backing off. The Fed's going to end the balance sheet unwind. It's like, I didn't think so. But I read the minutes. We're going to look at them together. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by sell any security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The rest of the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let me pull up the Federal Reserve website for you, and we'll get that loaded up, and off we go into the Fed world. So here we are on the Fed's website, and we are looking at the current FOMC minutes from December. And here's the part that the entire media is making a huge issue out of. It says almost all participants thought that it would be desirable to announce before too long. Again, so before too long, meaning some point in the coming year, so it'd be in 2019, a plan to stop reducing the Federal Reserve's asset holdings later this year. So there you go. Now, people are interpreting this to mean that they're going to stop reducing later this year. What I'm reading this is they need to announce by later this year what they're going to do. That's a big difference, a huge difference. And when you interpret it. So again, the market's saying they're going to stop unwinding in the second half of the year, at the end of the third quarter, at the end of the year. And that is inconsistent to what the Fed has said. We've had Fed speakers come out and say that, and even the head of the Fed, Jerome Powell, at the end of the January meeting essentially said, we didn't think we needed to be more clear about this, but we do. They're not saying we're going to stop it. They're saying we're going to tell you how we're going to do it, because they don't know. They didn't have a plan for it, because again, you'll hear them say this, the balance sheet unwind was like watching paint dry. That's what they wanted. That's what Janet Yellen said. We want this to be in the background, off the radar, off your mind. Don't even think about it, because we really know it's terrible. And when you figure that out, you're going to hate it. But in the meantime, just keep doing what you're doing as normal. And so again, major misinterpretation here. I don't know if this was deliberately misworded, because you can read it one of two ways, but it is in context of what the Fed has said. So I take this as by the end of 2019, the Fed's going to put a plan together to stop the balance sheet unwind. Now, whether that's going to be 2 more years, 3 more years, 1 more year, another day, we don't know. And they don't either. Let's go on. Such an announcement would provide more certainty about the process for completing the normalization of the size of the Federal Reserve's balance sheet. Here again, they don't know what size it needs to be. They're not sure. Again, this is not part of their plans, hence why I don't believe they're stopping it, again, as the market suggested today. If we go on and scroll down here to this section right here, I'll highlight that. It says the committee continues to view changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy, which is again consistent with what Fed Chair Powell said. The committee is prepared to adjust any of the details for completing balance sheet normalization in light of economic and financial development. We will come back to this in a moment. Moreover, the committee would be prepared to use its full range of tools, including altering the size and composition of its balance sheet, if future economic conditions were to warrant a more accommodative monetary policy than can be achieved by solely reducing the federal funds rate. Let's address the last one first. So all they're saying is, look, if we got to lower the federal funds rate to zero, we're probably going to stop doing the balance sheet unwind, which is exactly what Fed Chair Powell said in his last press release, or his last press conference after the January meeting. Again, this is nothing new, but let's go back to the thing that the other thing everyone's misinterpreting. Everyone is looking at this right here and saying, okay, yeah, they get the economic parts. It's the financial. So this is being translated as if the stock market goes down, the Fed's going to jump in. But anyone who's watched any of my videos on Friday, we go over the Fed's the Fed's balance sheet. We look at the data, we look at the charts. They haven't done anything. So they've continued to unwind up to $50 billion a month, as they've said they would, without any deviation. Now they've gone out on the press corps and jabbered their jaws a bit about, yeah, well, we may do this, we may do that. Look, it doesn't matter what they say. It matters what they do. And in this case, they're continuing to do what they said they're going to do. So again, I don't buy into all the misinformation here, but the market seems to be very excited about this. Stocks went up a little bit. Treasury yields went up slightly. In the end of the day, it wasn't a big deal, but the market's making it into something that it isn't. So now the next Fed meeting will be in March. And at that time, we ought to get the January meeting minutes somewhere right around the same time scale. I imagine they're probably about a week apart. And what we'll probably see in the January meeting minutes is, yeah, the economy slowed down in December. In fact, the Fed is even in this report that we just looked at, they said, yeah, we think the drop in the market was due to a liquidity issue. Yeah, it was. I'm going to show you what the liquidity issue is. It shouldn't be a surprise if you've watched any of my videos. So let's take a look at the markets, and we'll spend roughly the next 7 minutes or so doing that. And let me get over where I can see them. So here's the S&P 500. It's forming a unusual quadruple top. Now, I understand that you may not be able to see this, so I wanted to draw the line for you here. So, whoops. So there's 1, 2, 3, 4, and I will even help you out. Let's change it from red to green. Let's make it nice and big. And there you have 1 top, 2 top, 3 top, 4 tops. There is a quadruple top. This is your major headwind between right where we're at now, roughly 27.85 on the S&P 500 and 28.20. This is a major level of resistance, and I'm going to guess the market is going to reject it here. The secondary issue, if you're watching this on Wednesday, is the trade talks move to a higher level tomorrow. It's kind of weird that we have these long meetings and it goes up in stages. As longer the meetings go on, the more important people show up. I don't know why that is, but it's kind of the way it works. Friday they conclude. Probably nothing's going to change, but there's always hope. So anyways, how do we know that something is wrong here? Well, we can quickly go and look at Treasury yields, and we'll just overlay them, and then we'll go look at them separately. This is the 10-year Treasury yield, which shows that, yes, the market is way off, out of line. The S&P should be around 2,400 right now, and there's your answer. Now, where did the liquidity drain in October through December come from? It came from Treasury yields. Remember, I said when interest rates are rising and stocks are rising, there's validation. When interest rates are falling, they pull liquidity out of the market because they're forcing all the people that have been shorting the bond market to buy bonds. And guess what? It yanked liquidity out. People found some cash, some leverage, and mainly this rise here in the stock market is due to two components. Well, three, actually. Three. One, corporate share buybacks got kicked in at a high level, even though this is not sustainable because corporations are not going to buy back 78% more of their stock than they did last year. That we know already. We don't know exact the number of estimates, but it's somewhere, plus or minus around what they did last year. So that was the beginning. And then you had the CTA quant computer models buying, which brought the risk parity models to go out of bonds and into stocks. And I want you to think about it. Out of bonds into stocks, it's very interesting because interest rates went down. So other people were buying up these bonds as they got these computer programs to literally chase themselves up here. The big money managers did not join in this rally. They bought a little, but not much. In fact, they've been raising cash. So let's take a look at the 10-year treasury yields because there's a lot of insight in here. And this is the big drop right around this 2.625 to 2.6. And I want to go back even further and look what happens when yields get under this 2.62, 2.625, 2.6 range. It goes a quick drop down to roughly 2.3, quick drop, quick rise. But look, even over here, quick drop. So we know once this breaks, it's going to pull down and it's going to drag liquidity to the market with it. And even on the 30-year bonds, we see quick moves right in between these ranges. So we know when it breaks down from, say, 2.96, it's going to get down real quick into this 2.7% range. So there's your liquidity pool. The bond market is telling you everything about what's going on, and that is it's not buying this. In fact, you see it didn't buy into the Fed minutes. It went up a little bit, but not much. So that is a minor issue. The other thing I meant to look at is the implied federal funds rate out of December. Let's go quickly take a look at that. And here is the median dot plot. This shows in the December meeting, the FOMC board still thought there was 2 rate hikes left for 2019. Now, we'll presume that's going to change a little bit in their January meeting minutes, but there you go. So we've got a few 2.5 minutes left. I want to show you real quick. This is a chart from Teddy Valley on Twitter, and he posted the inverse of the dollar against gold. And look, you can see there's this big gap. Gold is rising on no news. Now, some people are saying this is the CTA quant models that have exhausted them, chasing themselves up, and it's possible. But you'll see it right around this 1250 number, which I've been saying is where I think it's got to reconfirm. So let's go back to the charts real quick. Check out gold futures. Here we go. And let's look at this, zoom out. So we've seen this heavy resistance for the past, say, almost 6 years is right at this line here around 1360. And see, it gets real quick up to here, and it didn't have any confirmations. And right in here is 1250, where these two purple lines are and the 100-day moving average in blue. So you kind of see every time it ramps up here, it comes right back to around 1250, reconfirms it. It ought to do it with these moving averages. Here's a 200-day starting to turn upwards. And we can even look at the weekly moving averages, and you can see that right underneath here is a 200-week moving average. So there's a lot of support that shows that we are entering that bull trend. But I don't buy the fact that this rally with a lack of news is doing it. And part of that reason is usually gold takes off under financial uncertainty. Now, we do know based on world dollar liquidity, we're headed back into recession and the central banks are tapped out, but there's just no catalyst here. I mean, as much as I am bullish into where gold is headed, I don't see anything here that gives me a major indication of what's going on. But I still think there's a big pullback here, and that's where you want to buy because now it validates this upward trend. If you get a nice pullback into this 1250 range and it holds the support down here, it's really telling us the trend has changed because every time it came down here, it at least made another stab at this breakout level. So you see it got up here, got rejected, came down, and then took another run at it. I think this time it's got the power to do it. And the gold miners, they kind of got a little excited of themselves too. Again, I think they're going to come back down right into this $20 to $20.50 range and reconfirm somewhere right in here. Maybe, I doubt they'll get as low as 19, but somewhere right in here would be nice confirmation of this downward pattern reversing. Because otherwise, when we look at this from a longer trend scale, you can see when it does these big run-ups, it takes a hard reversal down. And I think we're going to break out of here. And when it does, the first move is going to be up to here, where I'm going to guess it's going to get rejected. But this is still a nice looking chart. It just has no catalyst behind it. And it really, really needs one. Otherwise, it's just... there's no reason for it to keep going higher. So some people say it's $1. I've looked at the dollar chart. It's not really that. Mainly it's people saying the computer models are buying. I buy into that because they're all bought in now. So we've got the whole market stretched out now onto the upside. There's really no other news now other than the trade war. And we're about to see some weakening, more economic news that's showing the United States economy is weakening because the rest of the world is. So that's our update for Wednesday. We'll be back Friday with a more comprehensive weekly economic update. I'm Steve Van Metre. Thanks for watching.